Welcome back to the deep dive. We're here to, cut through the
Get
noise.
right to the core insights.
Exactly. And today, we're diving into the mind of, well, arguably the greatest investor ever, Warren Buffett.
hmm
How does he do it? Finding those wonderful businesses at fair prices year after year. It's like the holy grail.
It really is. I mean, look at Berkshire Hathaway. The record speaks for itself.
Right.
And what we want to do today in this deep dive is sort of demystify that a bit, pull back the curtain on this rule of thumb scorecard.
A scorecard.
Yeah, something savvy investors use. It helps spot the kinds of companies Buffett has historically gone for. High quality stuff.
Okay, I like that. And our sources for this. It's not just one thing, right?
No. It's a real distillation. We've looked at Buffett's own words, his letters.
The annual letters, always gold.
Definitely. And his actual purchases, you can learn so much just by looking at what he bought, plus independent research like those AAII buffology screens.
Yes, they tried to quantify his approach.
They did a pretty good job translating his philosophy into, actionable criteria.
So the mission for you listening in is basically to unpack these key numbers, these metrics, and also the qualitative stuff.
Give you a shortcut, really. An intuition for what makes a company potentially Buffett style.
And why each piece matters to him. That's key.
Exactly. By the end, you should feel, more comfortable spotting those really durable, high-quality businesses yourself.
Okay, let's get into it. But first things first, this scorecard. It's not like set in stone, right? These aren't commandments.
Not at all. That's crucial to understand up front. Think of them more as minimum hurdles, maybe.
Hurdles, okay.
Because Buffett himself is known to adapt. He might waive a metric or tighten it if the qualitative story, the business itself, is just that compelling.
So the story can sometimes trump a number.
It often can. Meeting most of these hurdles, yeah, that puts a company well inside the great company zone, no doubt.
But it's the whole picture.
Exactly. The overall narrative, the context, the business. It's not just ticking boxes. Like you said, the whole picture matters most.
Got it. So let's dive into the numbers then. The quantitative side. He talks about needing a strong moat, right? Profitability, efficiency. Where does he start looking for that?
Okay, the first big one is return on equity, ROE.
Right.
And for Buffett, the bar is pretty high. He's looking for an average of 15% or more over the last decade.
10 years. Wow. Why so long?
It shows durable profitability, not just a flash in the pan. Consistently high ROE suggests a strong economic moat protecting profits.
And good management.
And good management, absolutely. They know how to make shareholder capital work hard, generate more profit from, well, less capital.
Makes sense. Consistency over time. Now, beyond ROE, there's also return on invested capital, ROIC, sometimes ROTC. Threshold there is 12% or more, average over 10 years. What's the difference, really? Why look at both? Does ROIC tell us something deeper?
It does, yeah. ROE is about equity.
Yeah.
ROIC is broader. It looks at all the capital,
Yes.
debt and equity.
And-
So if a company consistently earns well above its cost of all capital, that's powerful. It means they're creating real value from every dollar they use, no matter where it came from. It's a sign of, top-notch operational skill.
Operational excellence. Got it. And then just pure earning power. Net profit margin. He wants that above 20%. That seems really high.
It is high. It's elite. It tells you directly about pricing power and cost control.
How much they keep from each sale.
Exactly. How good they are at turning revenue into actual owner earnings. If you've got that kind of margin, you've got something special, a strong brand, a unique product, some kind of cost edge.
Something that lets them keep a big slice.
Right. And often that starts even earlier with a high gross profit margin. You'd probably want to see that over, say, 40%. That's your first clue about pricing power.
Okay. Now, this next one is interesting, maybe a bit surprising. Depreciation divided by gross profit, 10% or less. This feels very specific to Buffett's taste.
Oh, absolutely. It goes right to his dislike for capital-hungry businesses.
Businesses that constantly need reinvestment just to stay put.
Precisely. If that ratio is low, it means the business spits out plenty of gross profit without needing to pour tons back into maintaining machines, buildings, whatever. They aren't just eating cash to tread water.
So it points to those asset-light, cash-generative models he likes.
That's the ideal, yeah.
Okay, so that covers profitability and efficiency. But Buffett is famous for being cautious, right? Hating risk.
Definitely.
So once a company looks profitable, what's next? The balance sheet, I assume, making sure it's solid.
Exactly. He wants a fortress, like you said, not a house of cards. First stop, debt-to-equity ratio.
And the threshold.
Less than 0.5. Keep it low. This minimizes financial risk, keeps interest payments from dragging things down.
Like he said, great businesses don't need much debt.
That's the idea. Financial independence Rock solid.
And ensuring they can actually pay the interest on the debt they do have.
Right, that's interest coverage. EBIT divided by interest expense, you want that 3 times or more, shows they can easily handle their debt payments from operations.
Comfortable cushion. What about just, day-to-day cash, unexpected stuff?
That's where the current ratio comes in, greater than 1.5. It's that vital liquidity cushion. Enough short-term assets to cover short-term bills.
So they can handle shocks or jump on opportunities.
Have that dry powder, exactly. Essential for stability.
Okay, moving on. Growth and predictability. Buffett loves consistency. Earnings per share, the EPS record. He wants it positive and rising every single year for 10 years.
Yeah, every single year.
That's incredibly tough.
It is. But that's what signals steady, forecastable earnings. Allows for reliable reinvestment, reliable growth. It's key for long-term compounding.
And related to that, shareholder equity growth or book value growth.
Yep, looking for 10% compound annual growth rate or more over the last decade.
Yeah.
And crucially, no single year where it actually shrinks.
No down years in book value growth. What does that signal? Why is that so important?
It tells you that the money the company keeps, the retained earnings, is being put back to work effectively, reinvested at attractive rates.
Growing the underlying value.
Exactly. It's tangible proof management is allocating capital well within the business.
Yeah.
It's pure wealth creation for shareholders.
Okay, now this gets really interesting for me. Cash generation and allocation. Free cash flow, FCF, needs to be positive every year, and FCF relative to revenue over 5%. Why the laser focus on cash specifically? Isn't profit enough?
Not always, because accounting profits, they don't always equal actual cash in the bank.
Right, accruals and stuff.
Exactly.
I know.
FCF tells you the real cash generated after paying for operations and necessary investments, the maintenance CapEx we talked about.
The money left over for the owner.
That's it. Cash for dividends, buybacks, smart acquisitions. If earnings are high but FCF is weak, those earnings aren't much use to an owner.
Got it. Cash is king. And then return on retained earnings. 12% or more. This feels like a core Buffett idea about management skill.
It absolutely is. Ties right into his famous test. Does $1 kept by the company create at least $1 in market value?
Ah, that test.
This metric shows if management is reinvesting profits smartly inside the business at high rates, adding value with every dollar they don't pay out. It's the ultimate test of internal capital allocation.
Okay, let's talk owner earnings. The 10 cap rule. First, how do we even calculate owner earnings? It sounds specific.
It is. It's Buffett cutting through accounting noise to find the true cash profit available to the owner.
Well,
Think about buying a small, local business.
okay.
You wouldn't just look at its net income on paper. You want to know how much cash is really left for you after paying to keep the business running, fixing machines, placing inventory, all that.
The maintenance capital expenditure.
Exactly. So owner earnings is basically net income, add back depreciation and amortization, but then subtract that maintenance CapEx and adjust for working capital changes too.
Okay, so it's a measure of real, sustainable cash flow.
Yes, and it has to be positive every year. But here's the valuation kicker, the 10 cap rule.
Right, the purchase rule.
He says, only buy if the annual owner earnings you expect are at least 10% of the total price you'd pay for the whole company today.
So a 10% pre-tax cash yield on your investment?
Essentially, yes, it builds in a margin of safety relative to, say, long-term bonds, a very tangible valuation check.
That is powerful. And speaking of valuation, his discipline is legendary. Never overpay. So, quick checks. Price to book ratio, 1.5 or less.
Yeah, a simple classic check. Is it cheap relative to its assets? Keeps you grounded.
Prevents paying crazy prices for the balance sheet.
That's right. And then price to earnings, PE.
Yeah.
He likes 15 or less, especially versus the company's own history.
Even for great companies.
Even for great ones. Limits paying for hype or speculation. Ensures you're not getting caught up in market frenzy.
And the foundation under all that valuation discipline, margin of safety. Pay at least 25% less than your conservative estimate of intrinsic value. Non-negotiable.
Absolutely non-negotiable. That's the ultimate buffer. Protection against being wrong, against bad luck.
And these limits, the 15 PEA, 1.5 price to book, that's the Graham influence, right?
Straight from Benjamin Graham, his mentor. Like Buffett says, he's 15% Graham, 85% Fisher. He blended Graham's value and safety focus.
With Fisher's focus on great businesses.
Exactly. Finding those quality companies with growth potential. It's that fusion that's so powerful.
Okay, but it's not all numbers, is it? There are crucial qualitative filters, too, beyond the spreadsheet.
Oh, definitely. Maybe even more important sometimes.
First up, durable economic moat. We hear that phrase constantly. What does it actually mean for Buffett?
It's that sustainable edge, the thing that protects profits and market share from competitors long term.
Like what?
Could be a powerful brand, think Coke. Or network effects like a payment system or a social media site getting stronger as more people use it.
Uh?
Could be a big cost advantage, maybe from scale.
Mm-hmm.
Or even regulatory hurdles like a utility license.
Mm-hmm.
High barriers to entry.
So it keeps competitors out.
Keeps them at bay. It's
Yeah.
what allows for that sustained high profitability we talked about earlier. Absolutely critical.
And then the people running the show. Straight shooting, rational managers. What's he looking for there? Honesty.
Honesty, yes.
Mm.
But more than that, he wants brilliant capital allocators.
People who make smart decisions with the company's money.
Exactly. Where to reinvest, manage debt, make acquisitions, when to give cash back to shareholders through dividends or buybacks. They need to act like true owners, treat shareholder money like their own.
Partners, not just hired hands.
That's a good way to put it.
And finally, on the qualitative side, an understandable business model. He famously avoids things he doesn't get.
If he can't reasonably predict how it'll make money 10 years from now, he won't touch it. Doesn't matter how exciting it sounds.
Simplicity and predictability.
Key words. He needs to grasp how they make money and why they'll keep doing it. No complex derivatives, no black boxes. It prevents mistakes born from just not understanding.
Okay, so we have all these metrics, these qualitative checks. How does an ordinary investor actually use this scorecard? It sounds like a lot to juggle.
It is a lot, but you can break it down. First, use it as a screen.
Filter the universe.
Exactly. Run screens for companies that clear most of those quantitative hurdles, high ROE, low debt, consistent EPS, etc. You'll filter out tons of companies right away.
Okay, so you get a shorter list. Then what?
Then you got to roll up your sleeves. Dig into the annual reports, the 10Ks, read what management says.
Verify the numbers. Check for consistency.
Yes. See if those metrics hold up over business cycles.
Yeah.
Look for that long track record. And check for the qualitative stuff, the moat, the management quality. Does the story match the numbers?
And assuming it checks out.
Then you value it yourself properly. Use discounted cash flow, owner earnings models, maybe EVA, whatever robust method you prefer.
And crucially.
Insist on that 25% margin of safety. Don't even think about buying without it. That's your protection.
And it's not buy and forget, right?
Definitely not. Monitor annually. Great companies stay great by compounding value, by continuing to allocate capital well. It's about durability. This isn't get rich quick.
It's get rich slowly, you said. Okay,
Yeah.
where did all these hurdles even come from? It's not just random numbers.
No, a lot comes straight from Buffett's own writing, especially that 1986 letter. That's where he really laid out the owner earnings concept.
Right, seminal stuff.
And later letters emphasized book value growth, returns on retained capital. You can see his thinking evolve, focusing on real value creation inside the business.
And you can see it in his actual buys, too, right? Reverse engineering his portfolio.
Absolutely. Look at Coke, Moody's, Amex, even Apple more recently.
Hmm.
Over multi-year periods, they clear these hurdles. The academic screens, like AAII's, basically just quantified what his successful investments already showed.
So the back test confirmed it. High ROE, low leverage, rising EPS. Those are the common threads.
They found the statistical sweet spots that match his holdings. It works in practice.
Plus that underlying Graham foundation.
Can't forget Graham. That 15% Graham is crucial. The 15 PE, the 1.5 price to book.
Yeah.
Those valuation guardrails are pure Graham. Safety first.
So it's that blend. Graham's value discipline plus Fisher's focus on business quality.
That synthesis is the magic, really. Rigorous valuation, insistence on safety, combined with finding truly excellent businesses with moats and growth prospects.
Okay, so let's wrap this up. To synthesize this whole deep dive, putting it all together means start with quality.
High, stable, RE-ROIC, double-digit equity growth, strong balance sheet, low debt. Check, check, check.
Then confirm the cash economics.
Owner earnings positive every year, turning into real, usable cash. Minimal reinvestment needs. Got to see the money.
And finally, discipline on price.
Those Graham limits, plus demanding that 10% owner earnings yield. Get that margin of safety. It's non-negotiable.
But again, these are guidelines.
Not gospel. Buffett himself bends them sometimes, especially for a truly extraordinary moat. Apple's a great example, trading way above 1.5 times book when he bought heavily.
But the closer a company fits this grid,
The more it looks like those wonderful businesses at fair prices that built Berkshire. Using this checklist forces you into that Buffett habit. Demand exceptional economics and a rational price.
the twin pillars. It's a really powerful framework for evaluating any potential investment.
So the question for you is, what company might you look at differently now, armed with this scorecard?
That is a great question to mull over. This deep dive certainly gives a clear roadmap. Well, thank you for joining us on the deep dive.
Always a pleasure.
For more insights like this and to really deepen your investing knowledge, please do remember to like and subscribe. You can find us on Apple Podcasts, Spotify, or our YouTube channel, Deep Value Investing.
And check the episode description. We've put together a recommended book list on value investing there for you.
Oh, and one more thing. If you're excited about bringing Buffett's wisdom into a practical daily tool for investors, we're actually working on something. Consider supporting our initiative to build a Buffett Indicator app.
Yeah, you can find the details on our GoFundMe page.
That's right. It's at gofundme.com/arc turning Buffett's wisdom into a daily tool for investors. Any support is hugely appreciated as we try to bring that to life. Thanks again for tuning in.